Navigating the future of digital assets, blockchain, crypto and beyond. No se trata solo de cripto, se trata de un nuevo orden financiero, derivados que se ejecutan con un smart contract, equities que se tokenizan, colaterales que se liquidan en tiempo real. Esta mesa es un viaje por el corazón de la disrupción financiera global. Reúne a quienes desde Estados Unidos, Europa, Asia y Latinoamérica están escribiendo las nuevas reglas del juego. Reguladores, expertos en infraestructura, arquitectos legales y tecnólogos con impacto real. Hablaremos de stablecoins, pero también de ETFs automatizados, de plataformas descentralizadas, pero también de liquidación en tiempo real y digitalización de colaterales. El reto no es menor: proteger al inversionista institucional y retail sin frenar la innovación, supervisar sin ahogar, coordinar sin imponer. Navigating the future of digital assets es un espejo del mercado futuro, uno que exige una regulación que evolucione a la misma velocidad que las ideas. Bienvenidos al epicentro del debate global, con la distinguida presencia de
Tania Eisenman, especialista en Bitcoin y AI, analista en Bloomberg, Forbes, CNN Español y El Cronista.
Daniel Davis, former CFTC General Counsel, co-head of Financial Markets and Regulation de Keaton Munkin Grossman. Y para moderar el panel, Gary DeWall, former Senior Counsel and Chair de Financial Markets and Regulation de Keaton Munkin Grossman y presidente de GD Mountain Insights. Les damos la más cordial bienvenida al Risk Management and Trading Conference 2025.
Well, welcome. We're not going to be discussing wealth management. In a way, we will, however. We're going to be discussing a new financial asset, crypto assets. And I'm delighted to be here with Dan and with Tanya. And hopefully we'll entertain you. If you have questions as we go along, please feel free to interrupt us and ask your question immediately. And we'll try to address it. So I thought that the first thing we do is sort of discuss each of our initial stories about how we got involved in the crypto space. Dan Davis, the former General Counsel of the CFTC, why don't you lead us?
So I became General Counsel of the CFTC in March of 2017, so about 8.5 years ago. And one of my first assignments as General Counsel was to write an ethics opinion about Bitcoin, because Bitcoin is considered a commodity under the Commodity Exchange Act, and CFTC employees have ethics obligations with respect to the holding and trading of commodities. But that guidance had never been updated for Bitcoin. And so I had to write a memo about ethics and what the CFTC employees had to do with respect to Bitcoin, because that was a year, you can believe it, people were very excited because Bitcoin was moving up to about $17,000 per coin, which I wish I should have bought more back then. That would be my good wealth management strategy back 8 years ago. But that was a year at the CFTC where digital assets really took off. Bitcoin was going up in price. Bitcoin futures were being traded on CFTC markets. And so the agency was really spending a lot of time on digital assets. But that was my initial introduction to digital assets.
Tanya?
First of all, good afternoon, and thank you for the space. I found Bitcoin in 2017. It was a very interesting journey because I was graduating from high school. I had come from a former professional tennis career. And so I was figuring out what it is that I wanted to do in life. And I found the Bitcoin white paper through a random link on the internet. And based on that, I actually decided to gear my entire career towards that paper, which I think a lot of people would say is a very risky decision. But in my head, it just made sense. I think that when I saw that Bitcoin was a scarce asset, when I saw that there was a real technology behind it, that it wasn't so easy to have any kind of transactions that would go and people wouldn't know what's happening. There's like full transparency. In order for it to be hacked, it's also very difficult. It's something that I had seen that ever since then, if you see Bitcoin from 2009 till today, if you had $1 Bitcoin then in 2010, for example, and then you had that same equivalent in BTC today, it would be $136 million, which I think too would have been a great investment. Unfortunately, I was a bit late and I was a bit small by then. But I thought, well, it's never too late. I think starting now is the best thing that I could do. And that is how I found Bitcoin.
Yeah, and I'll say my foray into crypto was sort of interesting. I was a derivatives lawyer most of my career, responsible for the futures and options and traders that we had and the brokers we had in my old company. But I'm going to say my foray in crypto actually began in the 1970s. Why? Because even though I knew I wanted to become a lawyer as early as my entry into college, I always was interested in other things. And one of those other things was computer technology. And so as an undergraduate, I took a course in coding. And then a bunch of years later, when I was in business school, I took another course in coding. So I was sensitive to coding. And just like you, in 2014, I joined this law firm. All my friends were there. I thought it'd be unfair for me to compete with them in the derivatives space. That's why the firm had hired me to help out the derivatives practice. But I didn't want to take business from my friends, so I had to find something different. I read the Satoshi white paper, and it clicked. It made sense. I mean, at that point, it had been 4 decades since I had taken my courses in computer programming. But what he said made sense to me, and I found it incredible that somebody was proposing to disintermediate financial entities, the institutions, and effectively have a system that ran by itself. And I thought I was just intrigued by that. I studied up, and then short term afterwards, we were able to actually get the approval of the CFTC for the first entity that had come in for an application to become a registered exchange with the CFTC, an entity known as Ledger X. So that's sort of my background. But as I say, I really attribute it to my work in the 70s. Now, Dan, you and I gave this panel last year, and we had tears in our eyes. Everywhere we looked, somebody was bringing an enforcement action against clients of ours. And it was really a very difficult time to practice law in the crypto space in the United States. I heard things changed a bit.
Oh, they have?
Yes.
Oh, okay. No, it's been it has been a complete change of events in the United States with respect to crypto. I mean, as Gary was saying a year ago, our kind of running joke with clients is, the United States has determined that everything that happens in the digital asset space is a security. It's subject to the securities laws, and there's no way for digital assets to comply with the securities laws. And so we're going to sue you out of existence. We were defending a number of lawsuits, handling a lot of subpoena work, and doing a lot of document review and getting people ready to give their deposition testimony and writing briefs. That has all gone away. And it's really remarkable because, I've been at an agency when you've made a change in administration. And normally what happens when you have a change in administration is a lot of things that the prior commission did, especially in the enforcement area, continues on, right? I've spoken with chairman who said, yes, I would not have brought this case that my predecessor brought, but I don't really want to, make this case go away. I'm going to see this case through. That is a very common thing to happen in the United States when you have a change in administration. Crypto has turned out to be the exception, right? Because instead of the current administration saying, yes, we disagree with the Biden administration did with respect to all of these cases it brought against, digital asset companies, we're just going to get rid of them instead of not even seeking a settlement. By and large, all of those cases were dismissed voluntarily by either the agencies or the Department of Justice. A number of investigations that were going on with respect to a number of our clients were closed. It's very uncommon in the United States, at least with the regulators that we deal with, to get like a formal close to an enforcement investigation. Normally someone will let it sit for about 2 or 3 years, and you eventually get them on the phone where they kind of hint that they're not going to look at it anymore. Not so with crypto. We would get closing letters where the agency would say, yes, we are closing the investigation. We're done. No more document requests, no more requests for witnesses, none of that. So it's really been incredible the amount of change that's been because, looking at past precedent, what you would have expected, sure, maybe no new crypto cases, maybe they wrap up some investigations, maybe they do some settlements or something, but no, it was completely the other way, shutting down the investigations, closing out the cases. And, we'll talk about this more, but, the Trump administration putting out executive orders and creating working groups saying, we're going to focus on crypto. The U.S. is open for business for crypto. So yeah, the tears of pain have become tears of joy, I guess, over the past year.
Yeah, and it is an interesting pivot by the U.S. regulators. On an earlier panel, I commented that in connection with new technologies, regulators always mouth the words, "We are technology neutral," and in fact, the Securities and Exchange Commission in the United States, under former Chairman Gary Gensler, also said that. He said, "I am technology neutral." But he was not technology neutral because he put every obstacle possible in the path of every type of crypto development. If it was associated with a blockchain, it must have been a security, and it was a real problem. It was a real problem. Now, just pivoting a little bit more, Tanya, let's talk about one crypto asset in particular. Obviously, we know that there are multiple crypto assets. We're going to discuss some of them later on and how they're going to play into the future of finance. We know that there are crypto that serve as store of value, and Bitcoin is certainly one of them. We know that there are crypto that have certain utility aspects and are perhaps programmable, like ETH. And take it from there. We know there are coins that represent something. Maybe they're NFTs, non-fungible tokens. Maybe they're tokenized securities. We know there are coins that are just, who knows what they are. They represent something. Meme coins. Our president of the United States certainly knows a lot about meme coins. And the list goes on. But let's key in on that one coin, Bitcoin. And why don't you tell us a little bit why you think it's something that people should really be paying attention to, even if they're not paying attention to today?
So one of the things that people might not know is that globally 1.7 billion people in the world are unbanked, but 1 billion of those people have a phone, and Bitcoin can be a solution to help bank them overnight. A lot of the times, and speaking not just in Latin America, but across the globe, we are born with certain privileges. We have a birth act. We can access the financial system legally. Some people just don't have those opportunities and are born in very different circumstances. They might not even know how old they are. And those are things that sometimes are not really addressed. But if we look, for example, in Mexico, it's about 54% of the population that is still currently unbanked. And for every transaction that is done from $30 or less, that's 80% in cash, which means that society is still trying to figure out how can we use the current system that is the financial system that works, that we like, that is protecting people, that is trying to make sure that we go against anything that is fraudulent and against any risks that can hurt someone who might not know enough about finances. But at the same time, we need to find a way to integrate these people into day-to-day life. And so something like Bitcoin, for example, where you have a phone, you could just download an app and then be able to transact with another person, can do different things. And I'd like to share an example. There is a personal family that I know, which was a teenager, and he was trying to save money in cash under his bed. And his parents were so poor that they were stealing the cash from him. And this was causing problems. And this is very sad because this is coming from a person who is trying to save, is not trying to take credit, is not trying to do anything illegal to acquire money. And yet still, he is still having this challenge. He can't even save. And so through a technology like Bitcoin, for example, he was able to save. He was able to make a difference and thus actually help his parents now that they don't have to steal from him. And this technology, and what I wanted to mention is almost that it can almost transcend a little bit further than what we see in our day-to-day life. A lot of the times, maybe the perspective might be focused on institutional investors or people who already have of wealth, and Bitcoin is really for everyone. And it's something that a regular person can actually have access to. And almost from that moment forward, if they had, let's say, a small business, they could show, no, I have all of these transactions. I want to be able to integrate back into the financial system. And then the financial system can look at all these numbers and say, okay, this is what we can do for you, even though you don't have a birth certificate or other commodities. Furthermore, I'd like to speak a little bit on other things that have happened across Latin America. Like we know in El Salvador, Bitcoin was accepted as legal tender. This is very important because a country that was so small, so unrecognized, had a lot of security issues across the country, was able to turn around using this. And then first the legislators were looking at it saying, well, we don't really approve. It's too risky. We don't like it. And so they were saying, no, no, no. And now suddenly that the investment has duplicated as a state policy, they're saying, well, this is how we should spend it. And now suddenly they almost feel like they have a bit of a right to say where the money and where the eggs should be spread out through the country now that it actually worked out. We have other countries like Argentina, for example, that stablecoins have been very prominent. So even though it's not legal tender, it's still certain ways almost legalized where people can use it. And you have other cases like in Venezuela and Bolivia, for example, where there have been such complicated political issues that are happening in the country where people know about stablecoins, not because they care about stablecoins, but because, for example, they were using a video game that was a little cow and they were farming, and using those farming, they got little digital coins and using that instead of the legal Bolivian tender. So now they use crypto all the time. They're using stable coins all the time. And this is just part of the natural developments of people not wanting to know about crypto, but having to use crypto and integrate it into their day-to-day lives in order to survive.
Well, thank you. And I was told, actually, he was a former chief economist for the Commodity Futures Trading Commission, who's of Ukrainian descent. He currently lives in the UK. And he was telling me the story. He obviously has some relatives in Ukraine, that when Ukraine was first attacked and people were fleeing the Donbas, the eastern section of Ukraine, he said many people were very, very glad that they had Bitcoin because it crossed the lines of international boundaries. It didn't make a difference that they went to Poland or they went to the United States or they went to Mexico. They still had easy access to their account, unlike folks who still had money in their banks back in the Ukraine. And I was struck by that. Dan, not only did we do a pivot in the legal area per se, but just very, very recently, the President of the United States issued with something called the President's Working Group a colossal going forward direction document. Describe that a little bit and tell people where the President of the United States would like the United States to go in the crypto space.
Yeah, so it's very interesting. President Trump has issued, quite frankly, a record number of executive orders. I don't think we've had this many executive orders in the United States in this shorter period of time since Franklin Delano Roosevelt was president almost 100 years ago. But among that, great stack of executive orders, in the first 10 days or so, he issued an executive order with respect to digital assets. And one of the things that executive order did was set up a president's working group with all of these U.S. federal agencies that interact in the crypto space, the CFTC, where Gary and I used to work, SEC, the Treasury, the banking regulators, and a number of things. And there's a lot of things that executive order required, but one of them was for that group to get together and within 6 months to put out a report about what the state of crypto was, what type of legislation might be needed, what types of things the regulators themselves could do. So it was filed away amongst all the other dozens of executive orders that were going on. And we waited, and sure enough, 6 months later, the report came out, and it's a very substantial report. It takes a while to read through all of it. It's not quick reading, but it's a very thorough examination of crypto in the United States. There is some analysis of crypto internationally, but there's a lot of focus on what the current authorities are within the United States with respect to crypto regulation, and looking at a number of potential pathways that can happen both at the regulatory level, using rulemakings and guidance and what have you, and also at the legislative level for the United States to, quite frankly, try to catch up. in the crypto space. During the past administration, I think a number of other jurisdictions have been doing a lot of legislating, and quite frankly, the United States is behind. And so this President's Working Group and this report really seems to be designed for the United States to try and quicken its step and try to get things moving again on the crypto space. Instead of sending a bunch of enforcement actions, let's give some regulatory guidance. Let's engage with the crypto industry and come up with some solutions so you can have regulatory protections, but you can also have the innovation developing in the U.S.
Sure. And for those who are not familiar with the complexities of U.S. regulation, if something is a security, the SEC basically can regulate it to the cows come home. If in the crypto space, even though the CFTC has broad authority over commodities, it only has rulemaking authority to the extent that the commodity is the subject of a derivative. It doesn't have spot market authority per se. Interestingly, it has enforcement authority. So if there's fraud in connection with the sale of crypto, the CFTC has authority. Otherwise, it doesn't have plenary authority. The states in the United States have authority, however, potentially under their anti-money laundering rules or under specifically drafted crypto-type legislation, such as the New York bit license regime or equivalent regime in that Illinois has developed. So it has been a complete mess to begin with. And so the CFTC certainly had the authority to pull back lawsuits it had brought, but it really doesn't have anything to do with the spot market, with a big footnote. Both the SEC and the CFTC, within days of the president's report coming out, have announced some initiatives to try to do something. Why don't you give some background on that?
Yeah, so the CFTC, the one I'm the most familiar with, is exploring what authority it has to regulate spot crypto. And there is one provision of the Commodity Exchange Act that applies, and it applies to a certain subset of the spot crypto market. And these are transactions that are first to retail persons, right? So it's not to big, institutional players, but they're spot transactions that are leveraged or financed in some sort of way. And they're a type of transaction where actual delivery doesn't happen within 28 days, right? Because for a standard Bitcoin transaction, like I transfer my Bitcoin to Gary, Gary gets his Bitcoin, and then I have no more claim of the Bitcoin. That's actual delivery. If actual delivery doesn't happen, if it's a leveraged transaction, if it's to retail people, the U.S. Congress many years ago gave that authority to the CFTC to require registration, to require compliance, because that type of a transaction economically is basically the same as a futures transaction. And that's where the CFTC's expertise is. And so the CFTC is exploring, are there things that the agency can do to encourage regulated entities to list these types of retail spot leverage transactions on CFTC regulated markets? Because the authority's there. You don't need to ask Congress for anything else, but nobody's done it yet. And so the question is, are there hiccups or are there problems that the industry sees that hasn't led them to list those things so far? So that's happening on the CFTC side. On the SEC side, there's a lot of discussion about initial offerings, right? So the SEC came out, this is almost 10 years ago, talking about initial coin offerings or generally securities offerings, and those are subject to the securities laws. Well, people who do initial coin offerings have had trouble complying with the securities laws because the SEC hasn't been very responsive to their questions. And so the SEC is putting out guidance and having task force and having roundtables where they're exploring, okay, so I want to do an initial coin offering. That's going to be a security, very likely. If it is, what can I do to be in compliance with the securities laws? And so that conversation of how to fit the technology with the current rule set is currently going on at the U.S. agencies. And it's a conversation that really hadn't been happening over the past 4 years because you get an enforcement action and you put your shield up. Now the shield's coming down a little bit and people are actually talking a bit more with each other. And the agencies are, slowly but surely issuing guidance and statements about various parts of the digital asset ecosystem. And it looks like that's going to continue.
Yeah, and just within the last 48 hours, the current chairman of the SEC, a gentleman by the name of Atkins, pronounced that he thought that most crypto assets were not securities. Now, interestingly, in the past, we were behind international regulation in this space in our prohibitions. For the chairman of the U.S. Securities and Exchange Commission to say that most crypto assets are not securities actually will have international implications. Because, for example, the UK considers a lot of crypto assets securities. And internationally, a lot of regulators consider a lot of crypto assets to be securities. And now you're going to have this situation with the U.S. securities regulators saying, we're going to see how that plays out. Now, another development that has happened recently in the United States that has some international implications that folks here in Mexico should pay attention to is a new law was just passed a couple of weeks ago called the Genius Act. Dan, I ask you to help explain what that's all about and how it has international implications.
So the Genius Act has to deal with stablecoins. And Tanya was talking a little bit about stablecoins earlier. Your most common type of stablecoin is a stablecoin that's backed by a particular currency. In the United States, there's a number of stablecoins that are backed by the U.S. dollar. And so the Genius Act is really the first United States crypto-specific legislation. And it creates a regulatory regime for these stablecoins, right? It gives requirements for if you want to be able to issue stablecoins, you've got to register with either a state regulator or a federal regulator, depending on some certain circumstances. You agree to certain capital requirements. You agree to certain disclosure requirements. You agree that, you're always, someone holding your stablecoin is always going to be able to redeem it for, the underlying currency that it represents. You're obligated to hold reserves for every, piece of stablecoin that you have. And so that became law just in the past couple of weeks. There's about a year-long time where, the various federal regulators need to do rulemakings to kind of set up the structure around the foundation of the Genius Act. But really what this creates internationally is a situation where U.S.-backed stablecoins, have, a regulatory perimeter and, if not the backing, at least the blessing of the U.S. government to operate in a number of different ways, to operate as, collateral for loans, collateral for, margin in derivatives transactions, being used for bank settlements, and being used in accounting to be able to treat it as cash. And I know enough about accounting from talking to accounting people that that's a big deal. That if you can count a stable coin as a cash or a cash equivalent, there's a number of accounting advantages that you receive. And so I think what this means, internationally for places like, Mexico is that, stable coins backed by things like, U.S. currency, Mexican currency, UK currency, EU currency. It's gotten, a big nudge, or maybe a big push would be a better word, a big push from the U.S. government, where it's much more legitimate. It's almost kind of what El Salvador did with respect to Bitcoin. It adds another layer of legitimacy to this type of product. And stablecoin is really a key component of the ecosystem, because there's a lot of people who are going in and out of Bitcoin or in and out of Ether, and, they're, trading in much of different ways. The stablecoin is designed, like a money market fund. It's a place where you can place your assets, and it's supposed to kind of stay in a stable value while you figure out what you want to do. And so you don't have to exit the digital asset ecosystem to be in an asset class that's supposed to have a lot of stability around it. And so it adds another, pillar to the digital asset ecosystem that has more stability around it. And I would anticipate that, other countries and in the U.S., it's just going to legitimize and, bring more people to trade in digital assets and to start purchasing their first stable coin.
Yeah. And just two things to follow up to be specific. Yeah, the Genius Act provides that a non-U.S. entity that is subject to local comparable regulation has the ability to apply to be considered a viable, legitimate stablecoin in the United States. So if a Mexican bank would come up with its own stablecoin and it was subject to regulation that was judged comparable by the U.S. regulators, then there's a path for it to be legitimized and provided to U.S. persons. The other thing that's interesting about stablecoins is already, because of the Genius Acts, some of the financial institutions, particularly clearinghouses, particularly clearing organizations under the commodities laws, are looking at the possibility of permitting stablecoins to be used to settle financial transactions. And the advantage, obviously, is 24/7 settlement. You're going to suck a lot of the risk out of the financial markets, which obviously, depending on how you look at that risk, is either good or bad for you. But it is possible. The next step that's not been accomplished yet, but is well underway, is a general regulatory scheme for digital assets in the United States. And Dan, why don't you help us understand what that scheme might look like, and also what the path forward on that scheme might be?
Yeah, so this is the Clarity Act. It's in the United States. It's the market structure bill, and this is as Gary and I have been talking about. In the United States, there are a host of different regulators that have some sort of piece of the digital asset pie, and none of that is set out specifically by statutes, right? So if you're a securities lawyer, right, you're looking at acts in the 1930s and the 1940s and trying to figure out what they mean when you apply them to this new technology that's, about 15 years old. And as you can imagine, that creates a lot of poor fits and a lot of complications. And so what the Clarity Act is designed to do is to strengthen those lines, those jurisdictional lines between the various federal agencies. So it's much easier to ascertain, oh, this is a CFTC issue. Oh, this is an SEC issue. Oh, this is an issue for, a banking regulator. So that's one part of the bill. Another part of the bill is, as Gary was talking about earlier, at the U.S. federal level, there's no full regulation of the spot crypto market, right? If you're just talking pure Bitcoin, unless you're talking about fraud or manipulation, the federal government really doesn't have much of anything to do with you. The Clarity Act would change that. It would put a lot of the spot crypto market under the jurisdiction of the CFTC. And it would set up a principles-based regulation, set up registration obligations, set up core principles that, entities would have to follow, but very similar to the way futures and derivatives entities are currently regulated under federal law. So that, in broad terms, is what the Clarity Act is attempting to do. It's gone pretty well. The Clarity Act has passed the House of Representatives, and so currently it sits in the U.S. Senate, where a couple of Senate committees are looking at it and evaluating it. It'll probably get marked up at some point, and there's a very good chance that once the Senate is done with it, it'll go back to the House, and they'll have an opportunity to try and pass the bill. Some estimates I've seen said that it's about a 50-50 chance that the Clarity Act will become law before the end of this calendar year, and a very good chance that the Clarity Act will become law within the next year or so. And so this is an area that the U.S. crypto industry is very focused on. There's been an enormous amount of engagement with the Congress and with the president and the White House about the Clarity Act. So there's still some discussions going on, but there is about some of the details. But there is an enormous push from the digital asset industry to get the Clarity Act passed. And so there's a very good chance that it's going to come to fruition. And again, like the Genius Act, the Market Act would help create some stability, clearer rules of the road, make it easier to innovate because you kind of know what you need to do to comply with the law instead of guessing and hoping that you don't get sued. And that's entrepreneurs much prefer to be in that situation for some reason. So it's a very exciting time in the United States. Like Gary was talking about with the Stablecoin Act, if the Clarity Act passes, I think there'll be international implications because it'll be another model for international regulators to look at and say what it is they like about that regulatory regime, what is it that they might want to have be different about that regulatory regime when they're, continuing to work on how they're going to regulate digital assets. I think it'll also increase, worldwide interest in digital assets. It'll be another place where it's easier to transact in digital assets. And so you'll continue to have some of those network effects as more and more people get exposed to the asset class.
And I think that just like when Dodd-Frank in the United States was passed and the concept of swap dealer came about, and that had very, very significant international implications with folks all around the world applying to become swap dealers with the CFTC, there are going to be three principal registration categories under the Clarity Act. One is a digital commodity exchange. One is a digital commodity broker. And much like swap dealer, one will be a digital commodity dealer. And all these entities will have certain, paths to engage in certain conduct in a legal way. And as Dan said, my expectation is that international regulators will study this. Folks will take advantage of this internationally, whether their localities enact similar provisions or not. But it's likely to become a model globally because it really is very, very straightforward legislation. Now, let's just go back to stablecoins a little bit because there's an interesting debate going on. And Tanya, you might have had some comments in addition to Dan about this. So obviously, we've talked about the fact that that much of TradFi even is looking at stablecoins now with great interest. You're seeing consortiums of investment banks. It was announced Morgan Stanley, Goldman, JP Morgan are all looking at either issuing a common stablecoin or individual stablecoin. There's a lot of talk about, all the benefits of stablecoin, but there are some discussions of potential issues. It's not all apple pie, so to speak. Dan, I don't know whether you can speak to some of the potential issues that people are talking about in connection with stablecoin that are not obvious.
Mm-hmm. Yeah. So, I mean, there's, there is concerns that have been expressed in some quarters about like, okay, so a stable coin based on the US dollar is going to bring, a lot of US dollars into the stable coin ecosystem. Oh, where are those dollars coming from? What are they being taken away from? And how will that impact, the non-stable coin uses of of the US dollar? And, there's some concerns that could create some friction or some instability with the U.S. dollar as, a move towards more stable coin environments happens. We have had experience in the United States where stable coin issuers have been sued and have settled with federal regulators for not having the reserve assets that they claimed that they had. There's been a couple of settlements both at the federal and the state level where those reserves have, not been in place, and there's been settlements. And so there's a concern, there is a concern like, well, is the system going to be robust enough that we can trust, a stable coin issuer to have what they need to have when, those redemptions happen? Because if you get a situation where a stablecoin issuer has a problem and can't redeem, you have something that's supposed to be a relatively safe part of the market that's not functioning well. And if you have that loss of faith, you could have cascading effects. It's similar to, the argument goes, it's similar to what happened around the Great Recession, where there were some money market funds that were pegged to the dollar. They're supposed to always peg to the dollar until the day where they weren't pegged to the dollar. And there was a big concern, well, these money market funds aren't supposed to do that, but now they're doing that. What's going to happen with that? So there's, like any new innovation, there's always concerns about, what's going to play out. And, regulators need to be smart about that, and the industry needs to be smart about that, because the last thing I think anybody in the digital asset industry wants to go through is something like the FTX bankruptcy again. That was a very painful period in the growth of this industry, and those concerns will be ever present, and you've got to look for ways to try to mitigate that risk.
Tanya, thoughts about stablecoins?
And I want to elaborate on what Dan was saying is that a lot of the times when we look at differences between a stablecoin, for example, and Bitcoin is what you just mentioned, that it could just be printed into oblivion. And yes, they say that they have reserves, but making sure that those are regulated. There's people behind it. There's a board of directors. There's a CEO. There's a marketing team. There's so many things that happen to it that is behind. And there's just so many people involved that when there's people, there's complications. And Bitcoin is very different in that sense. There are no people behind Bitcoin other than the actual miners who can't mine more than the 21 million Bitcoins that there are right now. They can't actually change the rules of the game. They can't make it any more safe or unsafe with the current system that they have for the technology. They just have a different position where Bitcoiners and stablecoins and the other coins like meme coins and so on are almost like drifting into two different paths, where I think sometimes people have to understand that a stablecoin might be useful for a purpose, but is not necessarily the replacement of a technology like Bitcoin. Bitcoin was designed for everyone in a certain way where nobody could actually get in the middle and say, well, if someone wanted to send one Bitcoin to another person and Tanya wanted to send something to Gary, then Gary could have the liberty of receiving it. And in a stablecoin, for example, if that evolved to a CBDC, which is fairly similar, then there is very much a regulation. And then a country could say, well, we want to eliminate fiat. And that's very dangerous. And in a certain way, Bitcoin is almost protecting a little bit of that, because Bitcoin would be the digital fiat. Bitcoin would be getting in the way in such a form that even if the stablecoin issuers are not having the easiest time doing what they're doing, Bitcoin already solved it. And it's so special how it was able to solve that ever since 2009, 2010. So I think that that's very special that Bitcoin had the capacity of almost overrunning all of these things without having any corporations and interests behind it, or even just like the actual stocks and bonds that you can just issue more. Even gold, some people don't know, it increases 1.5 to 2% every year. Bitcoin is truly finite, and there's no person, there's no coercion, there's no technology can actually change that to make more of it. And thus, because it is actually for the first time truly scarce, is so special.
Yeah, and one of the other things about stablecoin that folks are beginning to think about is that if consumers start purchasing stablecoins as opposed to putting their money in bank accounts, it is going to affect consumer lending. Why is that? And that's because when consumers put their money in bank accounts, banks only have to keep a fraction of that money handy. They can lend out the rest of it, the whole reserve requirement, which may change. That's not the case in stablecoins. In stablecoins, somebody has to put 100% of the underlying currency somewhere, and that cannot be lent out. So some people have expressed a concern that the prevalence of stablecoins may have an impact on the availability of credit by consumers, but we'll see. Now, Dan, Tanya mentioned the word CBDC. I think the Genius Act dealt a little bit with the CBDC. Maybe you can discuss the difference between CBDC and stablecoins, and what is the U.S. attitude on CBDCs these days?
So CBDC, central bank digital currency, the short version is the current administration does not like it. And the Genius Act says, no, we will not have it. The concern about a central bank digital currency is obviously it would be, instead of a stable coin that's issued by a bank or an issuer, central bank digital currency would be something issued by the government, right, and controlled by the government. And there's obviously a number of potential benefits that similar to what stable coins have. A lot of concerns that have been expressed about CBDCs is the ability of government to control every aspect of your financial transactions, right? In theory, if the government is issuing you the CBDC and can track where your CBDC is going on a blockchain, in theory, the government could have insight into all of your financial activity and could potentially stop or halt or revoke your financial activity. And so there's a big discussion going on with a lot of countries I mean, China's been very active in the CBDC space with the E1, and there's been some concerns about the Chinese monitoring of the E1 and having that type of insight into what you're doing and control about what you're doing financially. But right now in the United States, it would take a change in administration right now to see CBDCs come forward in the U.S.
Okay. Now, one of the great potentials that people are thinking about in connection with digital assets and its evolution is tokenization. The most rapid type of tokenization that folks are thinking about. In fact, the Securities and Exchange Commission has included that on their list of to do quickly, is to figure out a path of tokenizing traditional securities. Dan, can you tell us a little about what that would entail and where's that going?
Yeah. So, I mean, I'll use a stable coin, for example, right? A stable coin, $1 of U.S. stable coin presumably represents $1 of U.S. currency. Same idea with tokenization, except instead of the underlying being a dollar, it's a share of stock. And the notion would be that the token trades as a representation of the stock value, and it either is an additional representation of the stock certificate, or what people are saying eventually becomes the stock certificate itself. And the notion of some additional physical or electronic record of your stock certificate, in theory, becomes unnecessary, right? And then the tokenized asset can trade, just like Bitcoin and other digital assets trade. And the theory would be you have all of that information regarding your stock certificate sitting in one place. And so in theory, transfers would be easier. Transfers could happen at any time. You would have confidence about the underlying integrity of the underlying information. And it's, like you said, it's something that the SEC looks like they're going to go full speed ahead in exploring how it can be done.
And as you mentioned, it is likely in that case, those tokens would be considered securities because they're just a substitute for ordinary securities. But the SEC has indicated it's going to try to address the ancillary issues. For example, today, there are lots of requirements around the issuance of securities, lots of requirements around the distribution of securities that are in the public domain for a period of time. Some of those requirements may make no sense in the digital space. They have to be addressed. They have to be moderated. But the SEC seems to be willing to do that and is on a path to do that. It is also anticipated that we're going to see now that you're not afraid to be sued every week by a regulator, a whole development of all sorts of other types of tokenized products, tokenized commodities. Maybe you can speak a bit about some of the other potential tokenizations out there that you've seen.
Yeah, I mean, gold, silver, and anything that currently trades on a market in theory can be tokenized. I mean, I've heard someone who wants to offer fractional interest in antique cars, right? So you can say you own own a piece of a Mustang or what have you, and you can have the digital certificate there. So the concept is fascinating. I mean, it's like we were talking in this morning's panel. There used to be, the trading pit, and you'd have to go physically to go call out your trades and make your trades happen that way. In theory, tokenization could allow all of this to happen on the blockchain.
Yeah, and again, I think that when the Clarity Act is passed in the United States, it again will provide a blueprint for the world. It's not to say that countries won't adopt their own version of laws, but it very clearly is going to put things in buckets. It's going to very clearly say this is a security, this is a non-security. There's even talk about a new type of asset called an ancillary asset in the markup that the SEC is doing of the Clarity Act, which are what are those things that are issued in connection with ICOs? How do we treat those? And the Senate Banking Committee is proposing to treat them as almost a third type of asset. Again, not a security, which is good, but subject to different types of requirements. So we'll see how that that plays out. Now, we just have a minute or two left. I just thought we'd spend a second talking about, I mean, obviously, we've already seen a great run in consumer interest in crypto assets. We've seen great interest in meme coins. We've seen a great interest in Bitcoin. We've seen a great interest in these new financial assets. A year ago, we were crying because you couldn't do anything and it was overregulated. Dan, are we moving too far in the other direction?
No, I think, we're giving the market an opportunity to let this shake out, which is, I think, the best way to have things shake out. I don't know what are going to be the top 5 coins 10 years from now. But the best way to have that sorted out is to have them get out into the market, have consumers get to work with them, experiment with them, see which has the best use cases, and see what comes out, instead of those digital assets dying in the middle of an enforcement action. And so I think, this regime where we're giving innovation an opportunity, these coins are going to get a chance to be tested out. It's going to shake out. A lot of these things are going to fail. Some things that we're hearing about now are going to disappear 5 years from now. We're never going to hear from it again. But the innovation is going to get a chance to, be tested in the marketplace, and the best use cases and the best opportunities are the most likely to win.
Tanya, any final thoughts?
Well, the best performing asset has been Bitcoin for the last decade. So that's all I wanted to mention.
Okay. Well, we tried to cover an awful lot in a very short time. And we thank you for your attention. I don't know if we have any other questions.
I thank Tanya and Daniel under the skillful guidance of Gary Duvall to discuss this complicated and enriched subject. Thank you very much.
You're welcome.
Thank you.